Good afternoon, everyone. Welcome to today's session on emerging markets. I think we've definitely landed the infamous graveyard slot. Last panel session of the day and straight after lunch. So for those of you who I haven't met yet, my name is Shane Wollendorp, and I'm a global investment specialist at M&G and based in our Cape Town offices. I wanted to kick off today's session just with a very quick recap and look back at emerging markets. So the term emerging markets first emerged in the early 1980s, and by 1988, the MSCI launched the MSCI Emerging Markets Index, establishing the first widely recognized benchmark for EM equities. Now, around the same time, Brady bonds marked the birth of EM debt, and in 1993, JP Morgan introduced the Emerging Markets Bond Index, giving investors with a formal benchmark for EM sovereign debt. Now, since those early days, the landscape has transformed quite dramatically. So, for example, the MSCI EM index originally started out with just 10 countries and accounted for less than 1% of the global equity universe. When you look today, it spans 24 countries and accounts for roughly 10% of the global equity universe. Similarly, on the bond side, if you look at the JP Morgan EM bond index, it originally covered just 4 countries, so very concentrated, to now a much more diverse index covering 72 countries. And when you look today, the EM debt market accounts for roughly 1/3 of the total debt universe. Now, beyond investor benchmarks, EMs are also home to around 85% of the world's population and account for roughly 60% of global GDP. Now, despite their scale and potential, many investor portfolios remain quite underweighted or underrepresented to emerging markets. And on that note, I was actually quite intrigued to see the EM question outside, where there were actually many dots placed in both the underweight section and overweight section. So I think clearly there's room for discussion on this topic today. So I guess, is it time to rethink emerging markets? Today we're going to explore whether now is the right time for investors to reevaluate EMs, both from an equity and fixed income perspective. And on that note, I'm delighted to be joined by Claudia Kalic, fund manager for the M&G Emerging Markets Bond Fund and also head of our EM debt team, Ross Biggs, CIO for equities at M&G Investments Southern Africa, and then also Dave Perrett, fund manager for the M&G Asian Fund and also co-head of our Asia Pacific Equities team. So Claudia, maybe we'll start with you and perhaps start with a bigger, broader picture. In your view, what are the big macro forces that are currently shaping the outlook for emerging markets when you look today? And perhaps, is there one particular risk that's keeping you up at night and giving you sleepless nights?
Yeah, thanks. Well, first of all, thanks for inviting me to the panel. I think it's interesting because you did point to the beginning of the asset class, et cetera. And back then, a lot of the emerging market risks were primarily specific to emerging markets. They were problems of their own doing. If you look, I would say, over the last few years, and particularly this year now with uncertainty over global monetary and economic policy in general, I think the risks have become much more diffused. So some of the typical things we would look at would be still things we always look at, global growth, inflation, monetary policy, geopolitics. But I think what's changing a little bit the narrative more recently is the worry to some extent on developed markets as well, which this was never, or at least was rarely the case 10, 20 years ago. We're probably going to talk about currencies later, so we'll save the comments on the dollar for that. But I think to the extent that there might be some convergence of the perception of risks, basically EM is always going to be a little bit riskier, but it's just developing that it's starting to become a little bit more complicated, whether it's the US, even the Eurozone, et cetera. So I think that provides opportunities for investors to perhaps rethink emerging markets, look at it in a slightly different way, think like those challenges, they're not just specific to emerging markets. That will include fiscal challenges, growth, productivity, and so on. And more recently, I guess, technology, AI, and what have you.
So you mentioned developed markets in your response here and painted a relatively favorable picture for EMs relative to DMs perhaps. So, one question I have is, sentiment does seem to be changing more recently with respect to emerging markets, but some investors still do or are remaining quite hesitant when it comes to allocating to something like EM debt, for example. So why is it that investors remain hesitant, and what do you think they're potentially missing out on by not allocating to this asset class?
Yeah, I think, some of it is maybe a legacy of misperceptions. As I mentioned earlier, the level of debt, if you look over recent years, it's actually has been much more stable than the level of debt, for example, what you see on developed markets. So I think that should give investors comfort. The growth in emerging markets is structurally is expected, and it is higher than developed markets. So that allows you to carry perhaps a slightly higher interest rate burden while still keeping your debt dynamics pretty much stable. But more recently, it's interesting with particularly this year, we had huge uncertainty and volatility because of U.S. policy, et cetera. For the first time, I think in my career, we didn't see a rally on the dollar. In fact, the dollar was actually weakened, including for vis-a-vis emerging market currencies. So I think this is the beginning of potentially a very sea change on how people are perceiving what is the safe haven these days. And clearly, it's no longer just developed markets is safe and emerging is just a basket case. I think this it should give impetus to the asset class, especially considering we still have relatively high interest rates, relatively wide level spreads, relatively modest defaults. So there's no reason why to think the emerging markets should be looked separately. I think it should be really part of everybody's portfolio, even if it's just to diversify from what investors already have.
You mentioned currency there, and I want to stay on that point and maybe shift to something a bit more practical. When someone is looking to allocate to EM debt, one of those key considerations is whether to allocate to either local currency or hard currency, which is predominantly in something like US dollars. And with many EM currencies still appearing quite attractive and undervalued versus something like the US dollar, how are you and your team thinking about that allocation aspect?
Yeah, no, absolutely. This is a key consideration for us. We invest across the spectrum. We have been overweight local currencies. So from that perspective, the recent dollar weakness actually was beneficial to the portfolios. In fact, we are performing the benchmark quite nicely in a difficult year, for sure. I would say currencies are not overvalued. Current account positions, fundamentals basically are very supportive. Those economies are no longer as vulnerable before. I think you're mostly from South Africa. You remember the Fragile Five, which Morgan Stanley used to dub, including South Africa was one of them when the current account was absolutely huge. That has pretty much collapsed in many countries. So you have manageable external positions. And high yields, both nominal and real yields are extremely high. So I think local currency, but even hard currency, there are pockets of really attractive still proposition. And again, back to the dollar, I think it is interesting then again, just rethink of what is the dollar, what's a reserve currency. I had over the past month 2 meetings with 2 key central bankers, Mexico and Indonesia. And one of the questions for the Mexican Central Bank was whether Mexico is diversifying some of its reserves away from dollar into something else. And never in my career for emerging markets, I thought people actually are worried that Mexico has too much US dollar risk. This is absolutely a sea change. And Indonesia, by the way, they are diversifying as well. For example, renminbi, they increased 5% to now they're at 11% of their reserves, and they're doing a little bit of that with other currencies. So they may not go to every single emerging market currency by any means, but I think just a small sliver of this type of central banks moving should really support those currencies as well.
Thanks. Just before we move on to Dave and Ross, I want to ask you, also switch gears a bit and mention, obviously there's been a lot going on globally, if we just look year to date. And over the past few weeks, there's obviously been rising tensions in the Middle East. So just wanted to get your view on how you and the team are viewing these recent developments, and have you made any changes as a result from a positioning perspective?
Yeah, and sometimes I think the lesson for sometimes investors is making no changes is fine. Sometimes you try to anticipate geopolitical events, which by definition is extremely difficult to call. You may sell in the wrong moment, buy in the wrong moment. So we did marginal little trades, but not much because we just didn't have any insight on how this would pan out. So I think that's one. And the other, I guess, lesson is be diversified as possible. So in our case, we have portfolios with, you mentioned the benchmark, we have about probably 60, 70 countries represented. We have also a lot of corporates, local currencies. So there's always different parts of the portfolio that would respond to those geopolitical shocks differently. Whether, for example, we have commodity importers, exporters, oil importers, exporters, regional. We have a little bit of Middle East, but we have all kinds of other regions. So bottom line is, if you are diversified, that really allows you to navigate these uncertain geopolitical times.
Dave, I want to turn to you. Something else that's been making news headlines, or another major theme, is China and the impact of the latest US tariffs. And obviously, as a fund manager managing an Asian fund, China's a big component of that. So, how are you viewing this from an equity perspective?
Yeah, obviously it's a key question, and obviously we're very bottom up in what we do. But I always think we are macro aware, and we try and think about the right sort of context or lens to think about these issues. And I think if you start off where we began, even as soon as Trump came in, and then with Liberation Day, I think basically you have a sense of almost two partners who find themselves with irreconcilable differences, right? And then the opening gambit was, remember, we were just adding tariff upon tariff, on and on as they up the ante to 100% plus. But I think then at that point in time, there was also a battle of wills going on, with probably both, to be clear, both sides lose from this, and both sides feel pain, right? But the Chinese probably felt that actually the impact on them would be lagged compared to what was going to happen in the US, i.e. higher prices, empty shelves, right? And there's probably more of a political environment. And so you can see, in a way, the US began to work that out quite quickly, because they basically blinked first and said, we're not going to apply any of these to electronic goods, right? So on. But then, obviously the US then tightened up on high-end kind of tech exports, and that brought them together to talk in Geneva, and then you have this kind of initial pause. But that doesn't last too long either, because there's no trust, right? And so even though you've got the main people trying to talk to each other, you get other parts of the government doing various things. And I think particularly on the rare earth side, the Americans didn't realize quite how vulnerable they were, and the Chinese basically turned them off even after Geneva. And we began to see that impact in Japan and Europe and in the States. And so again, I think what the Americans did to try and get the Chinese back to the table was the hint they might start auditing the big Chinese banks, all of whom operate in the US, all of whom come under the regulatory purview of the Federal Reserve. And you think about all the things that happened in recent years and how proud China is about sovereignty. Whenever I meet their big banks, they always say, we do exactly what the Fed asks. We talk to them all the time because we cannot afford to be cut off from the dollar. So basically, they both raise the ante again, and they get back together again, and we have another pause, right? And so again, the way to think about this is, we have irreconcilable differences, but they found out they can't live without each other, right? China needs access to the US market still to certain degrees, and they need high-tech chips. The US needs rare earths, and also they need basically good valued electronic goods. So I think we found some sort of equilibrium. The trouble is that there is no trust, and so therefore it's easy for other parts of the regimes or governments who don't trust each other to sort of say, we need to tighten this, we need to do that, and so on. And so, how we try to think about this is not say, let's forecast how this plays out, although we think there is enough ground to an equilibrium over 2 or 3 years, because those needs on each side is not going to change quickly. There's no shortage of rare earths in the world, but there's a shortage of places who want to refine them, because they're incredibly messy, and the technology is really, really kind of, get the best out of it, quite high-tech, right? So the way we try and think about doing this in our portfolios is really from a bottom-up perspective, just try and look for inconsistencies in risk pricing. So when in April we have all this kind of fallout, rather than sort of saying, oh, we think X, Y, Z is going to happen, we sort of say, well, actually, some of these exporters are being completely pounded. That looks quite interesting to us, particularly if we sell some of our bank exposure, which has done very well in recent times. But really, if these large listed exporters, if this valuation makes sense, that means SMEs across the region are going to have a huge problem, right? And that's clearly not factored in the valuation of these banks. So it's more about then trying to navigate inconsistent risk pricing rather than a blank sheet of paper say, this is how the war is going to turn out.
And just moving to another emerging market country, which often clients ask about, and that's India. When you look at a headline level, valuations look quite stretched. I mean, I think India's still got a higher CAPE ratio than the US market.
Yeah.
What's your view on India? Are you still managing to find any opportunities through that bottom-up process?
Yeah, it's kind of interesting. So we're underweight in India in our regional funds. We reduced that underweight a little bit earlier this year because China had done relatively well. And actually, even though we're underweight, our best performing stock last year was an Indian stock. So we can still find things. We have a dedicated India fund and team, so we're looking for stuff. But in general, it comes back down to expectations and risk pricing, right? So if I said to you that India is a great macro story, right, it's not exactly insightful, right? And one of the analogies I sort of use to sort of make the point here is, sometimes you can almost compare India to a wedding, right? If you have the word consumer, okay, right, it costs X. You put the word India in front, it costs 2X, right? So you talk about flowers or a car, right? Then you put the word wedding in front, it doubles again, right? And so I think from our point of view, we see a lot of interesting stocks. We see a great structural story, but trying to find that kind of alpha, that kind of mispricing is very difficult in India. So we're underweight the market. We're always looking. This dislocation over this year gave us some opportunities, but in general, we still find much better opportunities in places like Hong Kong and Indonesia rather than, say, in India.
Great stuff. Ross, I want to move abroad to another emerging market, one the audience will know quite well, and that's South Africa. So bringing the conversation a bit closer to your home, do you think it's fair to say, as a fund manager based in South Africa, that you're already well trained in managing risk and the political uncertainty that comes from investing in somewhere like Africa?
Yeah, thank you, Shane. I think, coming from South Africa, I think we are particularly well trained in risk management. I think, in any emerging market, and particularly in Africa, if you've been working in these markets for a long period of time, I think you quickly realize that, risk management, having a good risk framework, is almost or even more important as, trying to find and unearth those investment ideas. So I think, to start off, I think that would be my main point. One of the questions that I'm getting a lot at the moment is, given what's happening in the world, we've got Trump and his tariffs, we've got missiles flying around, the uncertainty, the risk it feels very risky at the moment. And so, as an emerging market investor, why the heck would you be going into the riskiest area of the market at this point in time? And I think the first point I would make is that, whether it's developed markets and emerging markets especially, markets are always uncertain. There's always volatility, and, you never know what's around the corner. Today you might feel the environment's very risky. Tomorrow it might be less risky. Today it might feel, low risk, but there's very high risk around the corner. And so I think that's the first point I would make. When you're putting together a portfolio, you need to put together a portfolio which takes into account that the environment is always uncertain. And if we look at Africa over the past 15 years, we've seen some massive risks in those markets. We've seen a revolution in Egypt. That came very, very suddenly. And the stock market there was closed for 2 months during that revolution. So, you've got a country where the market doesn't function for 2 months. If we look at the currency markets, we look at Egypt, we look at Nigeria. The currency market in Nigeria has been effectively closed, or was effectively closed, for 4 years post-COVID. So, if you were an investor or a company trying to get hard currency in Nigeria, it was exceptionally difficult. And so I think the point I'm trying to make is that, if you're a company operating in these types of environments where, you've got a lot of volatility, you've got these massive risks coming along, you actually get very used to operating in that risky environment. So, a lot of these companies, they've been operating in these countries for decades, and, they run their balance sheets strong, then, they know there's risks around the corner. And so, a lot of these companies can actually manage these risks fairly effectively. Maybe one good example is when we first started investing in Nigeria about 15 years ago. we've got we do sort of a quick check on a company. So the first company we looked at in Nigeria was Nestle Nigeria, and we've got a sort of standard slide pack of charts that we go through. And we were looking at this company. I was like, actually, I think we've pulled the wrong code for this company, because this, the margins are so stable. I think we've pulled Nestle Switzerland, not Nestle Nigeria. And when we went to check, it was actually the case. This was Nestle Nigeria. The margins were not only stable, but they were in fact higher than the margins of Nestle Switzerland. And so I think that just sort of tells you the story that, there is reward for taking on the risks in these markets. And I think, what happens in these markets is that it's very difficult to compete because there are so many of these risks. The environment's so uncertain. So, if you're trying to enter that market, it's very difficult. And so effectively, you've got these big barriers to entry that actually stop competitors coming in. And so you can actually earn very nice high returns. I think, being South African, you can also appreciate that, because we've seen a lot of South African companies try to go and establish themselves in Nigeria, and, they come back 5 or 10 years later, having lost a couple of billion rand in the process. And so I think maybe the final point I want to make is that, as South African investors, we've seen, and African investors, we've seen and we've experienced some risks that you'll never see as a developed market investor in your lifetime. Currency markets closing for years, revolutions, high levels of corruption, and I think that puts us in a unique space of understanding risk. And so when you put together portfolios, we ideally want to put together the best possible combination of probability distributions, so that we can extract the very high return that's on offer for taking on that extra risk. And I think that's the key. It's having a diversified portfolio of many different ideas, so that you're not taking a particular view or betting the house on a particular outcome. You've actually, over time, you can extract that nice fat extra return that you get from taking on these risks.
And I want to stay on the topic of risk. One question I wanted to ask is, are you seeing any structural improvements from a corporate governance perspective that you think makes African equities more investable today? I mean, are there any good stories you have from company engagements or meeting with management?
I think when we look at companies, I think one of the main questions that we ask is how well do company management allocate capital? To us, that is the key sort of question. So when we're looking at a company, you look at the cash flows that the company is generating every year. How do the company management go and allocate those cash flows every year? And in order to understand that question, one of the key focus for us in the African markets in particular is how good is the corporate governance of the company. So, one of the key questions in looking at that in African markets is, how are minorities treated in these markets and in these companies? And I think, what we found, after many decades operating in Africa, is that it's essential to go into those markets and to talk to as many people as possible. So, when we go into Nigeria or Egypt or Morocco, we want to talk to as many people as possible. We want to talk to regulators. We want to talk to company management. We want to talk to, other pension funds, local pension funds in the market who've been around for a long time. We want to talk to other investors. We try to steer away from politicians. And in doing that, the question that we're asking them is, who would you not do business with? So, who do you think are the dishonest characters in these markets? Who would you avoid? That's the sort of key question that we're asking them. And I think, maybe again, to give you a good example, we went into Nigeria and there was a company that, looked good on the charts, but something was not right. The gross profit margin was too low. And I asked a stockbroker to organize a meeting with this company. And, in that meeting, what we uncovered was that the management were actually overinflating inventory cost prices and effectively extracting profits into one of their Swiss group holding companies. And so after that meeting, we came out of the meeting, the broker was, I must apologize because I didn't realize it was a bit of a dodgy company. And I said, those are actually the best meetings because, I'd rather know where the snakes are than get bitten by a snake. And so I think having that sort of local knowledge is critical when you're investing in these markets. And so maybe just a general comment to finish off is if I look over the last 20 years in most of the African markets, generally corporate governance has been getting better. When we talk to regulators, they are a lot more engaged than they used to be. And there's this big sort of sense of responsibility to bring their regulations and corporate governance up to developed market standards. So, the regulations might not be quite there to protect minorities, but it's definitely moving in the right direction.
Thanks, Ross. You mentioned Nigeria there as an example of a country. I just wanted to pick your brain. Are there any other countries or sectors across the broader African universe where you and the team are finding most value today?
Yeah, so I think, so Nigeria we find particularly attractive. And I think, the other country which has had its problems is Egypt. And I think there we also find, valuations look exceptionally attractive. So, yeah, both the Nigerian market and the Egyptian market at the moment, we think look particularly attractive in Africa.
And Claudia, maybe I can just come back to you. We didn't quite get there earlier, but from an EM debt perspective, is there any particular country, sectors, or instruments that are standing out for you today?
Yeah, we invest, pretty much globally, and we're quite diversified. But within regions, I would say we have, I would say overweight in high yield, and that would include some countries and companies in Latin America. We have also, CIS type of complex of Central Asia. We do have Africa as well. So it was funny you were talking about Nigeria, etc. Egypt, yes, yeah. So we are involved in some of those markets, including also the local bonds. So we have the Egyptian T-bills. We have the Nigeria almost for the countries that can invest in Nigeria, because we have also ESG funds that, some cases, some countries don't make it to the cut, and sadly Nigeria is one of them. So yeah, I think. Again, we have to really be diversified, especially given this time that we are still looking at various uncertainties, where it's coming from the U.S. and China, and so on. So bottom line is still a relatively yieldy portfolio, but if you look at the composition of returns and correlations, it actually has managed to also do well in a little bit of turbulent times just because of the diversification that we have.
Thanks. I just wanted to now open it up to the audience for any questions. So please use there we go.
Good afternoon. Thank you very much. Two questions. But first, an observation. You mentioned Egypt, and I think Egypt is positioning themselves as a Middle Eastern, North African powerhouse. Their private equity and venture capital side is way more developed than South Africa. But I'm not sure if you are how up to date you are with regards to what's going on with the obviously political component now. So firstly, what would be your prognosis with regards to how this could turn out? And secondly, from a risk management perspective, how do you actually build or manage the political risk that is continuously coming through from South Africa, and not other emerging markets? I'm saying specifically South Africa. Thank you.
Yeah, so I think I'll deal with the Egyptian question first. So, I think it comes down to, in my mind, you need to understand the environment, but I think, as I said up front, it's, these environments are always uncertain. So, I think a good example would be, before the Egyptian revolution, I had a lot of pressure to actually, we didn't have any investments in Egypt at the time, and I had a lot of pressure to actually put money there because the environment was good and everything looked like it was, going along swimmingly well. After the revolution, we started to invest, and the returns were fantastic, but the sort of, our risk managers were like, do you not understand there's a revolution, that's just happened in this country? And I think, that's our starting point. Valuation is our starting point. So, we've seen a lot of different cycles in Egypt. But our take, from talking to companies is that the government is very invested in trying to transform the economy. So if you look at a lot of the regulations that they're passing, over time, they're definitely going in the right direction. So that sort of speaks to, corporate governance. They're trying to do the right things. And so, we think Egypt looks exceptionally attractive at the moment. We've got an investment in CIB Bank. It's very conservatively provisioned, and it's exceptionally cheap. They've got exceptionally high interest rates at the moment, but that's sort of embedded in the value that you're paying. So, that bank, probably one of the highest quality banks, well provisioned in Africa, trading on a 5 times PE multiple. And then coming back to South Africa. So, I think, if you look at South Africa over time, it's actually produced quite good dollar returns. So if you go back, 25 years ago, people as South Africans, you often surprised at the dollar returns that South Africa has generated over long periods of time. So you go back 25 years ago, we've actually outperformed very slightly the S&P 500. If you go back, 60 years ago, we've outperformed the S&P 500 by about 1% a year. Those are actually exceptional returns, and they're very different to the sort of average perception that a South African has. And I think, I think it's worth keeping that in the back of your mind. And again, I think it's very difficult to structure a portfolio for a particular economic environment or particular, political outcome. I know it sounds difficult, but when we construct a portfolio, we want many different diversified ideas, which hopefully will, perform well under many different economic or political cycles.
Do I have a second on Egypt? Or, yeah, because we're also invested. But the other thing Ross didn't mention, but I'd like to add, is in terms of macro, they also bit the bullet. They allow the currency to devalue, but also importantly, they have an IMF program in place, and they just passed the recent review, which obviously has got its own performance criteria. And it's never fun to have an IMF program, but usually when countries get one, it just gives investors a little bit of comfort that the policies will go in the right direction, whether they're going at 100 miles an hour or maybe 50 miles an hour. Of course, there might be setbacks, but that's always comforting. So with investors coming into the local market, obviously that allows the capital account to remain open. So basically money coming in and be able to exit the country as well, which in fairness, there are risks. How long can this persist? But we still think in the near term, we're still in the trade.
Thank you. So just one last point, but the Egyptian economic minister, she was also the tourism minister, and she's exceptionally competent, and she actually retained 2 portfolios because she was so good at the previous job and was given a better position with economics. But you mentioned that you guys are involved with a bank there. Ironically, their venture capital private equity sector funded Time Bank in South Africa as well. So a bit of a loop around.
I think we have time for one more question. Any other questions from the audience?
Hi, sorry. Just in terms of the actual funds that you guys look after, benchmark, agnostic, or where are the respective funds?
So I do the MSCI Asia ex-Japan, and we are not benchmark agnostic, we're benchmark aware. So our view is if we can outperform by between 2 and 3% a year over time, that's kind of more than top quartile performance, and that's what our clients want from us, right? So some of our competitors maybe say, well, we love India, so we're going to be 25% overweight in India and have no China. That's fine, but that's, you got one bet, right? Whereas we'd love to have a number of different things driving alpha. That's how we think about things.
Yeah, I think from a South African and African point of view, we take exactly the same approach. So, we want as many different ideas as possible. We don't want to, bet the house on one particular view or one particular outcome. And so, we are benchmark aware. We want to, deliver returns of exactly as Dave says, sort of, you know, in the 2 to 4% range over time.
Yeah, in our case, we also cover the whole scope of emerging market debt. We recently actually launched a local currency fund. So we have the three basically building blocks, your MB, so your hard currency sovereign fund. We have a corporate fund, and now we have the local. But we also have a blended product that basically mixes all the three within the same product. So that's when the asset allocation between hard currency and local comes into play. So we pretty much cover the whole spectrum. And again, the idea is to outperform in both bullish but also bearish markets. So we don't have really a bias that we only perform well in certain conditions. No, the idea is really to deliver, sustainable performance over a 3-year rolling period.
I mean, to that point, I spent half of my career doing absolute return sort of hedge funds and half doing long only. And I think the key of all these things is to understand what the client wants and then make sure you spend the risk budget where you can add value to the client, right? And don't end up accidentally taking unintended risks, which then basically hurt you, and you don't really haven't intended them, and that's just the worst case outcome.
Thanks, Dave. I think we're out of time, so thank you very much to Claudia, Ross, and Dave for your insightful, sharing your perspectives today. And I think you're all going to be around if anyone wants to speak more on emerging markets later. Thank you.